So I just got back from the grocery store. I bought like some chicken breast, eggs, and supplies to make mac and cheese, and the prices were unbelievable. So naturally I came home, I said, that's it. I'm doing a food company, basic food company, and Tyson's who I settled on for the first video, Tyson Foods. So here, look at their PE is 11, their PB is less than 2, their price of sales is less than 1. I mean, this one's just inviting me to take a deeper dive, right? The only thing that some people might take as a downside, I don't really take this as a downside, but some people might, is that we're pretty close to the 1-year high. So some people might think, oh, it's already been priced in. I don't know about that. We're going to find out by looking at the financials. Let's start with the income statement and total revenue first. So here we are. This is every quarter going back to 2006. I think everybody knows what pattern to look for in the revenue now. Is it increasing or at least flat? And this one's increasing. So that looks good. I don't get a metric from here. Some people like to use price of sales. I'm not a fan of that because it ignores all their expenses, and I just think that's kind of crazy. But I like to make sure it's going up, and it is. Perfect. So now let's look at gross margin and see their competitive advantage. Try to judge that. So this is interesting. First off, their gross margin, they are not just a chicken company. They are chicken, pork, beef, and then other foods. For the pork and the beef, their raw materials are going to be the actual livestock. But for the chicken, they count their raw materials as the chicken feed because they also raise chickens. I thought that was interesting. Really, I just thought Tyson was a pure chicken nugget chicken company before I started reading their 10K and realized they actually own Jimmy Dean. They own Hillshire Farms, so they do much more than just chicken. But anyway, I just thought that was interesting. Let's talk about this gross margin and how it ties into inflation, okay? Because they're doing something pretty sneaky here, I think. And I think it's something a lot of companies are doing that's going unnoticed by the consumers. So if it was strictly just pure inflation and their raw materials were getting raised on them and they were passing those costs on to us at the finished products, you would expect their margins to be flat. But what's going on? The margin's not flat. The margin's actually higher. So what does that mean? I think that means they're using everybody's expectation of inflation to see how high prices they can get away with, right? Because they know people are just going to blame the higher prices on the supply chain, COVID, Brandon, take your pick, right? Nobody's suspecting that companies are just trying to see how far they can push the envelope. I mean, as a potential investor, I love this, right? But as a consumer, it kind of pisses me off. But at the same time, the inflationary cost has to go to somebody, right? I mean, we're paying more money at the grocery store. Who's getting that extra money? To be honest, if it wasn't going to Tyson, I'd be checking the farm companies. And if it wasn't going to the farming companies, I'd be checking the fertilizer and ammonia companies. If it wasn't going to ammonia, I'd be checking natural gas, right? Because natural gas makes ammonia, which goes into fertilizers, which helps farming, which helps the chicken feed, which helps chickens, and then finally gets passed on to us, the consumer. So somebody's got to be scraping off the top. And you know who else is getting a big chunk of it? Is the government, right? Because each time money changes hands, guess who gets a big chunk of it? You got it, okay? And that's kind of what that quote up top is. But anyway, as a potential investor, I like to see the increasing margin because that's how we're looking at it. All right, enough. I'm off the soapbox for inflation. All right, let's look at their, what is next? Interest to operating income. Okay. So this is going to tell us how much they're relying on debt to make money. I'm going to delete this big one over here to get the scaling back down. Okay, so recently decreasing. I don't think it's because their interest is lower. I think they're just making more money, so it's interest divided by operating income. So obviously I like to see this below 10%, but I'm a little worried that it's only below 10% because we're making so much money right now, and I'd want to kind of get a feel for how they would do if there was a downturn, because this is a cyclical business. All right, let's get a pre-tax income estimate. Yeah, look at this income. That's what happens whenever your revenue's growing and you get to increase margins like they're doing. Wow. One quarter had a huge spike, and you know it wasn't due to other income or something, because if I just show you real quick operating income, yeah, it's part of their operating income. Okay, back to pre-tax. I just wanted to show you that. Every once in a while, if you see a big spike, sometimes it's from other income, like they sold an asset or something. So you always want to make sure that if you see a spike, it's not due to some fluke sale or something like that. So anyway, how am I going to account for this? I'm going to include it, but I'm going to take a long average, okay? I'm going to go back like 3 years and take the last 12 quarters and average those pre-tax income numbers. So if I take the last 3 years, which would be 12 quarters, I get an average of $770 million per quarter, okay? So 770 times 4 is 3,000 million, so 3.08 billion. I'm just going to put 3.1 billion for my pre-tax income estimate. All right, and next I need to get a growth rate. This is kind of tough, I'm not going to lie, because how do you count for this? This is kind of an outlier. This would be one of those stocks that you'd have to really do some deep research into and say, do you think this is going to continue or is this a one-off? Okay, so I'm kind of no matter what, I'm definitely going to put these guys on a watch list and be looking at each quarterly result. But anyway, okay, let's get that growth rate I was talking about. All right, 2011, 2012, they were like, let's say $500 million a quarter. And then 10 years later, let's say 800 million a quarter. This is a rough estimate, but that's how I like to do growth rate. I like to be conservative and not overcomplicate things. Okay, so 800 divided by 500. So they went up 1.6 times in 10 years. To get that annualized, I raised that to the 1/10. And I get an increase of 1.048 times per year, which is 4.8%. So I'm going to say 5% growth. That's pretty reasonable. All right, lastly, earnings per share. Let's get that number real fast. Where is it? Right here. Okay, let me get the decimals in. Awesome. I'm going to take the last 2 years. So not the trailing 12 months, but the last 2 years. And if I do that, I get an average of $1.78 per quarter. So to multiply that by 4 to get a yearly estimate, $7.12. Okay, $7.12 per year. Awesome. No red flags in the income statement. So let's go to the balance sheet. Total assets is first. Y'all know I like to look at return on assets. In this case, I'm going to want to look at return on tangible assets, because if I show you their goodwill real fast. So they have like $10 billion of goodwill. Goodwill happens anytime you make acquisitions and you buy something over the book value. It's just how they reconcile the accounting. Let's say there's a company that's making a really good return on its assets and a return on its equity. You're not going to pay right at equity value, right at book value for that company. So whenever they make an acquisition, the balance, however much they pay over, gets booked as goodwill. The issue is this is not a real asset now. It's just the accounting fudge factor kind of. So I'm not going to include it in my return on assets calculation, because that'd just be silly. Remember, I say return on assets is like an efficiency factor for your equipment. So to include something that's not actually making you money, I'm not going to do that. So I'm going to subtract this out and get a return on tangible assets. Okay, so if I subtract it out and get a pre-tax return on tangible assets, this is in percentage. Let me do this. You can see recently it's okay, but that's a one-off compared to how it's been. And this is actually pretty low, especially whenever I subtracted out tangible assets. To have a return on tangible assets, between 6 and 4% it's not that great. There is one advantage to having a low return on assets, and that's that you're less likely to get competition, because who wants to go into a business where you're making 4 to 6% on assets? But is that really the reason that you want low competition? But anyway, I would put this is kind of a red flag. I don't like this at all. But anyway, let's look at inventory. Okay, so inventory is broken down, raw materials, work in progress. I wonder what a work in progress nugget would be. I hope they, wait, let me look at this. Okay, good. They don't have any. Yeah, if they were carrying like work in progress inventory, I think that'd be kind of gross. All right. Raw materials. So we look at raw materials because if a company is ramping up raw materials, that would tell you that they're expecting increased demand. So they're building up fuel ready to, make more products and sell more. It's going up, but it's kind of modest. This is just kind of a wash. There's no good or bad here from this trend. Let's look at finished products, because this can tell you a lot. So if finished products are going up, it's usually not a great sign. I like to see finished products flat. If inventory is growing, that means that they're building up inventory like on the floor, whenever really you want that stuff out the door. You want it as soon as you make it to be sold. The golden sign for inventory would be if raw materials was going up and finished products was either flatlined or going down, because that would tell you that the company's ramping up, getting all these raw materials, been building all this fuel ready to start going. But at the same time, every time they make something, it's getting shipped out as fast as they make it. I think the only company that we've done that's fit that ideal model was Tesla. But anyway, that's just interesting. This is going up. I mean, it's not skyrocketing, but at the same time, there's a lot of inflation, so there's huge demand for this stuff. I wouldn't expect finished goods to be rising that much, but I'm just a little confused by that. I guess at the same time, their total asset base is growing, so maybe this is just like they're getting more farms, more production units, so inventory is not really growing on a per asset basis. Well, shoot, let me just look at this. I'm going to pull up a metric that's finished goods per total assets. All right, so it's definitely not a red flag. See, their finished goods per total assets is actually pretty stable. So it's not like in each individual location they're building inventory. It's more like they're overall growing. So, okay, this is fine. All right, let's move on. Let's look at their equity, and I want to show you why you don't want to just always fall for whatever software you're using tells you the price to book is. Okay, so this is their total equity. Let me put it back in dollars. And you can see it's, $18 billion. So price to book, just based on that, would be your market cap, which is $33 billion, divided by 18, which is your equity. And that would be your price to book, 1.8. The issue is, remember I said they have like $10 billion of goodwill. So really that should probably be subtracted out. So if I do that and I just look at tangible book value, which is your equity minus your intangible assets, you can see that we're just now crossing to be positive. This is not a red flag. Just because a company has a lot of goodwill doesn't mean that it has like a negative net worth, but I think it means it makes it super difficult to calculate that net worth and that you shouldn't just use equity as a substitute. So this is just a wash for me. I think the balance sheet, it's okay. There's nothing super bad about it, but there's also nothing great that I saw. All right, let's go to the cash flow statement. First up, as always, free cash flow, and this is actually pretty good. You can see it's growing, and it's been growing steady for a long time. This is kind of all over the place, so I'm going to fit a trend line real fast, just a linear trend line, to see if I can see what it looks like in a couple years. All right, so yeah, about $600 million, let's say $700 million per quarter. That's going to be what number I use. So if I do 700 up here in the calculator, 700 times 4, I get $2.8 billion per year. Remember that 700 million, so 2,800 million is actually 2.8 billion. So that's going to be what number I put in the outline over here, 2.8 billion. All right, and now I want to look at depreciation versus CapEx, but I suspect they're going to be pretty close because our pre-tax income is pretty close to our free cash flow. So here's depreciation, about $300 million a quarter. And now if I go to CapEx, let's see, about 350, 300, about the same. No issues there. They're putting into their assets about as much as they're depreciating. That's normal. All right, let's look at share buybacks and dividends. Let's see how much value they're returning to shareholders. Buybacks is super important to me because that tells me if they think that the stock's undervalued. All right, obviously they're not buying back shares. Let me talk about share buybacks. A company buying back shares is always, I think, a good sign, unless management's crazy and they're buying it back just to prop up the stock, which you will see, but hopefully that's not always the case. If a company is not buying back shares, that is not always a bad sign. A lot of people think this is a yes or a no, and if they're not buying back shares, that it's just bad and should be avoided. I disagree with that completely. There are cases where a company shouldn't buy back shares, even though it could be a good purchase for the investor. I think Netflix is a good example of that. Somebody that's getting a great return on assets or great return on equity, that they can get more for their cash by just reinvesting in their own business. You don't want them buying back shares. But okay, anyway, that's another tangent. This company, however, I'd kind of like them to be buying back shares because they're getting a low return on assets. You would think if they thought their stock was undervalued, it'd be a much better investment than buying more chicken farms or whatever they do. I'm not sure. But I just thought that's interesting. Let's see if they're paying a dividend. Cash dividends paid. They are, and it's increasing. That's a good sign. Like I've said before, management is terrified of ever lowering a dividend because they know that the shareholders will just roast them alive because so many people hold stocks just for the dividend. So to see it growing is good. It's not a huge percentage of their free cash flow. So like 160 times 4 is 6.4 or 0.64. So 0.64 divided by their total free cash flow. It's okay. It's about a quarter of their cash flow, a quarter of their free cash flow. That's not terrible. I stand corrected. And also, if a company's paying out this much of its free cash flow as a dividend, it really changes the outlook on how their equity is growing back on the balance sheet. Because if a company's paying out dividends, that's money that's just gone. It's just leaving the business. So it's not going to show up in their net worth growing, but it is money that they've generated and paid out to you, to the shareholders. So just keep that in mind as well. All right, let's go to valuation. All right, first up is our pre-tax income times 10 divided by the number of shares. That is just a rule of thumb method, but I think it gives a good baseline for valuation. If somebody tells me a stock to look up, this is like the first thing I go look at. I go look at like their annual pre-tax income real fast and just compare it to the market cap, and it's just super easy. All right, so 3.1 times 10 divided by the number of shares, 0.363. That's $85 a share. All right, next one is the formula from Ben Graham's Intelligent Investor. So 712 times 8.5 plus 2 times growth. All right, that's 132, much better. That one's usually on the high end, but this is actually pretty high, so interesting. These two right here, this one's usually low, this one's usually high, so I think combined they actually give a pretty good price target. And lastly, the DCF. If y'all don't know, I have a video on how I do a discounted cash flow because what you're seeing here is just the inputs. There's actually a whole spreadsheet that's running in the background of this because you can't just do DCF on a calculator. If you're interested in that, it's on my channel, just go check it out. Okay, so free cash flow was 2.8 billion. Perpetual growth rate, I'm going to say 4%, and then I discount at 15%. Like I said in my free cash flow video, I understand people who discount like 10 to 12%. I think 12% is probably more precise, but I always try to be super conservative and discount at 15%. Okay, so net present value I get is $29 billion, And so 29 divided by 0.363, and I get $80 a share. All right. Average price target, $99. That's really close to the share price. I would say within 10%. I mean, it is within 10%. This one right here, the earnings per share growth one, I think is a little too ambitious just because these other ones are so close together, the pre-tax and the DCF. All that being said, this is one I'm really going to be watching. If they post another quarter or like 2 more quarters with income like you saw for the most recent one, I think this valuation changes drastically. And I think that this is a company that's benefiting from inflation, that's absorbing some of those costs. So it's definitely going on my watch list. The only big red flag I would say would be the low return on assets or tangible assets. I think I would like to see them buying back shares. I mean, especially with the low return on assets. If they thought the stock was undervalued, it seems like a much better investment, but that's just my take on it. Anyway, if you enjoyed the video, if you learned something, please like and subscribe. Check out more on my channel, and I will see you next time.